The Moving Average Convergence Divergence (MACD) indicator is a momentum oscillator that shows the relationship between two moving averages of a security's price, usually the 12-day and 26-day exponential moving averages, EMA. It consists of the MACD line, difference between the EMAs, the signal line, 9-day EMA of the MACD line, and the histogram, difference between MACD line and signal line. The indicator helps identify trend direction, momentum strength, and potential reversals. It is widely used for short to medium-term trading decisions due to its ability to smooth out price fluctuations and provide clear crossover signals. MACD generates buy signals when the MACD line crosses above the signal line, indicating an upward momentum shift, and sell signals when it crosses below, signaling potential downward momentum. Divergences between MACD and price actions can also indicate potential reversals. For example, if price makes a new high but MACD does not, this bearish divergence can signify weakening momentum. The histogram's size reflects the strength of the momentum, assisting traders in timing entries and exits more precisely. Empirical case studies demonstrate MACD's efficacy in various markets including equities, commodities, and forex. For instance, MACD-based strategies have shown effectiveness during trending periods but may produce false signals in sideways markets. Combining MACD with volume data or other indicators like RSI often improves signal reliability. Backtests using historical price data revealed that optimized MACD parameters tailored to specific securities and time frames enhance profitability and reduce risk exposure. Mark-to-market, MTM, valuation measures the current market value of an asset or portfolio based on prevailing market prices, reflecting real-time profit-loss positions. This approach increases transparency and accuracy over historical cost accounting, especially crucial in volatile markets. MTM helps traders and risk managers evaluate portfolio performance, manage margin requirements, and make timely strategic decisions. Regulatory frameworks often mandate MTM reporting to ensure financial stability and accountability. Trading benchmarks such as closing prices, indices returns, or sector performance set standards for measuring trading outcomes and relative performance. Benchmarks enable traders to assess the effectiveness of strategies against general market trends or peer groups. Selection of appropriate benchmarks depends on asset class, market liquidity, and investment horizon. Interpretation involves calculating tracking error and alpha to evaluate manager skill versus market movements, providing insights for strategy adjustments. MTM valuation affects portfolio risk assessment, liquidity management, and strategic asset allocation by providing up-to-date valuations reflecting market dynamics. It allows portfolio managers to recognize unrealized gains or losses promptly, improving decision-making on rebalancing or hedging. However, MTM can introduce volatility into reported earnings and capital adequacy. Portfolio managers utilize MTM data in stress testing and scenario analysis to mitigate risks and optimize returns. Modern trade data visualization employs advanced tools such as Tableau, Power BI, and Python libraries, Matplotlib, Plotly, that integrate large and complex datasets into interactive charts, heat maps, and dashboards. These technologies enable real-time monitoring of trade volumes, price movements, and order book dynamics. Integration with algorithmic trading platforms facilitates automated alerting and strategy optimization based on visual insights. Visual patterns like head and shoulders, double tops bottoms, and trend lines are fundamental in technical analysis for predicting future price movements. Volume and volatility heat maps reveal concentration of trading activity and potential breakout points. Visualization of time series data helps identify seasonality and cyclicality in trading behavior. Interpreting these graphical cues enables traders to anticipate market shifts and improve timing of entries and exits. Utilizing visual analytics leads to enhanced decision-making by enabling pattern recognition, anomaly detection, and scenario simulation. Traders can optimize portfolio diversification and risk-reward profiles by dynamically adjusting strategies informed by visualization outcomes. Firms using visualization-driven approaches report greater agility in adapting to market changes and improved predictive accuracy. Empirical evidence suggests a significant correlation between use of visual analytics and increase in trading profitability. Econometric models like ARIMA, GURCH, and vector autogration, VAR, are used to capture statistical properties of financial time series, including trends, volatility clustering, and correlations. These models enable forecasting of returns, volatility, and market dynamics, underpinning quantitative trading strategies. They integrate economic theory with statistical inference, improving predictive capabilities and providing systematic frameworks to evaluate complex market interactions. Backtesting involves applying proposed strategies to historical data to evaluate performance metrics such as returns, drawdowns, and Sharpe ratios. Robustness testing includes out-of-sample validation and sensitivity analysis to parameter changes. Development of quantitative strategies leverages machine learning alongside econometric techniques to optimize signal generation and execution rules. Transparent documentation and iterative refinement are essential best practices to ensure realistic expectations and reduce overfitting risks. Key challenges include model misspecification, overfitting, and data quality issues that can impair predictive accuracy. Market regime changes can invalidate historically calibrated models. Best practices emphasize continuous model validation, incorporation of economic fundamentals, and adaptive frameworks that integrate new data streams. Risk management frameworks and scenario analysis are critical to mitigate potential systemic failures in automated trading strategies. Simulation techniques such as Monte Carlo methods enable modeling of numerous capital structure scenarios, varying debt levels, equity issuance, and cost of capital assumptions. These simulations identify leverage ratios that maximize firm value while minimizing credit risk and financial distress probabilities. Incorporating stochastic inputs allows capturing market uncertainties, providing robust decision support for CFOs seeking to enhance creditworthiness and funding flexibility. Different methods of raising capital, including term loans, bonds, convertible debt, common and preferred equity, carry distinct risk-return profiles and impacts on credit metrics. Evaluations involve cost of capital assessments, repayment schedules, covenant considerations, and dilution effects. Comparative analysis through simulations can guide strategic choices to align with credit rating agency criteria and market conditions. Credit rating agencies assess capital structure changes by examining leverage ratios, interest coverage, cash flow stability, and refinancing risks. Simulations illustrate how altering debt-to-equity ratios impacts key rating drivers and potential rating upgrades or downgrades. Understanding the threshold levels that trigger rating adjustments helps firms proactively manage their capital policies to maintain or improve credit standing. This presentation has covered the implementation of technical indicators like MACT, the importance of mark-to-market benchmarks, and the power of visualization tools for strategic trading insights. We also explored econometric models for robust strategy development and capital structure simulations to optimize credit ratings. Together, these comprehensive approaches empower traders and financial managers to make informed, data-driven decisions in dynamic markets.